Welcome back to the deep dive. So you've shared a really fascinating stack of sources with us. We've got articles, white papers, research notes, and they all seem to point to this quiet but really fundamental shift happening in finance. And we're not talking about a new app or some trading algorithm. We're going deep inside the bank,
Yeah.
right down to the core ledger where the money actually moves.
Yeah, that's the mission today. We're going to synthesize these materials to really understand a critical structural change. AI is moving from being this after-the-fact analysis tool.
Right, like generating dashboards after the money has already moved.
Exactly. To becoming in-flow intelligence. So we really need to analyze what that means for stability, for control, and just how decisions get made moment to moment.
And this deep dive is brought to you by AI Opportune. AI Opportune is a space for founders, builders, and, curious thinkers exploring how AI is actually showing up in real work. Amid all the hype, it focuses on what really counts. The tools, the shifts, and the ideas that influence how we build and grow. You can expect practical insights and thoughtful conversations, so make sure you follow AI Opportune to subscribe and stay connected. Okay, so let's unpack this. The structural shift. For decades, intelligence in banking was, well, it was strictly external, an observer.
Totally. It analyzed reports, it looked for fraud, it calculated risk.
But always after transactions cleared. It was all done in batches, right?
Yeah.
It gave us a historical perspective, basically.
And that operational boundary is just.
Right.
It's rapidly eroding. The core change, which all these sources point to, is that AI is now operating much closer to the core ledger itself. But, and this is critical, it's not replacing the ledger. That's still the absolute source of truth. It's more like an intelligence layer that observes and influences decisions in real time.
So it's a fundamental change in how the systems think while money is literally moving.
Exactly.
So if the technology has been around, why was intelligence always, coming after the fact? The sources seem to suggest that the old core systems just weren't built for that.
No, they were built for certainty. You executed the transaction, you moved the funds, and then you analyzed it, often in those slow overnight batch cycles.
The system was designed to move money first, ask questions later.
Precisely. And that brings us right to the architectural engine that's driving this whole new reality. Event-driven architecture, EDA.
Event-driven architecture. Okay, that's the term that kept coming up in the material.
It's the key. Modern core platforms, like the ones from 10x Banking, are just built differently. In a traditional system, everything is kind of locked inside the core. With EDA, every meaningful action, a payment attempt, a balance check-it, generates an event the very moment it happens.
Okay, so give us a good analogy here, because event streams can sound a bit abstract. If the old way is like checking your physical mail once a day, what's ED?
EDA is like switching to instant push notifications. In the old system, you had to wait for a daily report to see what happened. With EDA, the moment the core system processes a payment attempt, it instantly broadcasts an event, a little piece of data that says, payment attempt initiated, $50 to this vendor. And this is the critical opening for AI. The AI models, literally, they subscribe to these real-time event streams. They can assess the context, the behavior, the risk, instantly.
And it returns a decision without slowing down the core ledger.
That's the genius of it. It doesn't slow it down at all. The intelligence operates during execution, in parallel.
Wow. I can see how that changes the game. So what kind of decisions are possible now that were just, off the table before?
Well, the applications are pretty transformative. For example, a fraud signal can now be evaluated before the settlement even completes.
So if I normally spend $50 at a store and suddenly I try to spend $5,000.
The AI can score that event, raise a flag, and trigger a hold, or extra verification, all within milliseconds. Risk scores get adjusted during authorization, not after the money's gone.
And you could even route payments differently based on that live context.
You got it. A high-risk transfer might go to a compliance queue, while a normal, recurring payment just sails right through.
That real-time context is really what separates this from just running a better report. But the sources, they point to something even deeper. They talk about agentic AI. What does that actually do?
It's the difference between prediction and orchestration. Agentic AI, and this comes from Architecture and Governance magazine, it functions as a decision orchestrator. It's not just spitting out a score.
Okay, so it's not just saying this looks fraudulent or this looks safe.
Right. It's actively evaluating the full context of that event, applying policy logic, and then recommending specific actions within these predefined safe boundaries.
So it's more about directing the flow of the transaction itself.
Exactly. In a workflow, the agent might influence the approval path. So if an event scores as, say, medium risk, it might recommend diverting it to a secondary check. Yeah. Or it could trigger a two-factor authentication just for that one transaction.
The ledger still moves the money, but the AI is shaping the decision environment around it.
That's a perfect way to put it.
And this is where we shift from those simple binary rules, approve or deny, to treating risk as more of a spectrum. How does that change things?
Well, the shift is pretty huge. InterSystems points out that we're moving away from those old static rule engines, the if-then logic.
If transaction is over $10,000, then flag, that kind of thing.
Yeah, and the bad actors learn those rules so fast and just operate right underneath the threshold. It created a ton of false positives, and you were always rewriting the rules.
It was a constant reactive game of catch-up.
With these continuous decision models, the criteria become fluid. The system stops asking if a simple rule was broken. Instead, it evaluates a whole profile: behavioral patterns, transaction velocity, the sequencing of actions.
So if a transaction scores as medium-high risk, it's not just a no.
Right. It could be a mid-spectrum action. Maybe it temporarily lowers a daily spending limit.
Yeah.
Or it allows the transaction but puts a soft lock on the next one until you confirm it. It's a much more nuanced approach.
But if the AI is orchestrating all this, what about stability? What about the regulators? I mean, isn't there a huge black box risk here?
That's a great question, and the material's really clear on this. The safety net is the defined boundary. The AI only advises the path. It never executes the ledger. And these modern systems have to be built with explainability baked right in.
So there's an audit trail.
Every single time. It has to show why a recommendation was made, which factors were weighted, what logic was applied. It has to be auditable.
Okay, here's where it gets really, really interesting for me. We're talking about all this modern architecture, but the sources like FinExtra confirm that most global banks are still running their core ledgers on COBOL-based mainframes. How do you reconcile that?
It's not so much a contradiction as it is a necessary compromise. Those legacy systems, they're absolutely unmatched in reliability and throughput. They're battle-tested. Trying to replace them wholesale would be, well, it would introduce a level of operational risk that no bank can afford.
You can't just flip a switch on the system that holds all the money.
Never. So the genius is in the interface, in the hybrid solution.
So you have the old rock-solid core and this new, fast, intelligent layer.
Exactly. Think of the COBOL ledger as the perfect, immutable historian. It records everything with total reliability. The AI, running on a cloud platform, is like a highly trained advisor whispering in the decision-maker's ear before they sign the record.
So how do they talk to each other?
Through APIs. Banks are exposing transaction events via APIs and streaming that real-time data to their cloud-based AI systems. The intelligent overlays observe the events without ever needing to change the ledger's core logic. The COBOL system guards the financial truth, and the AI handles the interpretation.
That's separation of duties. That's the key. Execution versus decision shaping. But as we synthesize all this, there seems to be one quiet dependency that underpins everything. And it's not about the models or the code.
It's the data.
The data.
That's the critical factor. What's so fascinating is that the success of all this speed and sophistication comes down to something that isn't sexy at all: data readiness.
Okay, so define AI-ready data. I mean, we know it needs to be unified, but why is that so hard for big banks?
Well, InterSystems defines it as unified real-time access to transactional, operational, and contextual information from across the entire bank. And it's hard because banks grow through mergers. They end up with decades of siloed systems.
Yeah.
Checking account data is in one place, loan data is in another, credit card data is in a third.
So the AI might see a payment attempt, but it's missing the context about that customer's other accounts because the data is trapped somewhere else.
Exactly. If the data is fragmented, the whole thing falls apart. I mean, think about a failure scenario. A customer tries to make a large international wire. The AI sees the payment stream, sees the amount as unusual, and recommends denial. But if the data was unified, the system would also see a parallel event. A huge, legitimate deposit just cleared 30 seconds earlier in that same customer's savings account. Fragmented data breaks that connection. Unified data provides the context.
And the sources really stress that this data readiness is more important than the actual algorithms being used?
By far, it is the central, unglamorous truth. You need clean, standardized, accessible data pipelines to feed those event streams. The models are only as good as the unified context they get.
So let's bring this all together for everyone listening. What this really means is that AI has moved from being a historical observer to an active, real-time participant.
Right. Banking systems are becoming responsive, not just reactive.
They're evaluating and advising as the money moves, rather than just reporting on what already happened.
Exactly. The core takeaway is that decisions are shifting from those slow, overnight batch cycles to continuous evaluation. The intelligence operates right beside that core ledger, watching every transaction, influencing the risk and the approval path before the money actually settles.
So that structural separation, the deterministic ledger executing the movement, and the agentic AI only shaping the decision environment around it, that's the key to stability. Which leaves a really interesting question. If that principle is the secret sauce in finance, what are the next defined boundaries we should expect AI to operate within in other highly regulated industries? Like transportation systems or healthcare diagnostics. How far can the advisor go before it starts demanding control of the historian? That's something for you to mull over.
A truly provocative thought to consider.
The future of AI unfolds here. Follow AI Opportune to stay connected to the conversations and insights shaping how we build and grow. Thank you for diving deep with us.